Everybody, and welcome back to the Teaching Tax Flow Podcast, episode 174 today. We are going to do a little bit of something different here. We're going to talk about when's the right time and some implications when it comes time to cut the cord on those kids when it comes to taxes. So we're going to make it nice, right? We're not kicking them out into the streets at all. Maybe go get their own place if they haven't done it yet, if they're at that age. But we're going to dive into some detail here. I think we broke this down into 3 phases. So, of course, there's a lot more depth we can go into, but this should help maybe ease that decision if you're really at that fork in the road. You know, again, don't kick them out just yet. But Chris Picciuro, welcome back to your own show, sir. How's it going, man?
It's going well. How are you?
I'm doing pretty good, man. And now that I think about it, I think my parents, I believe, kept me on for a long time as a dependent. We're going to have to go back in your archives, actually, because that's really how I met you 20-something years ago, right?
Right. Well, in this episode is not necessarily about someone being a dependent on a tax return. This is about when do we start educating our kids about taxes and having them involved in the tax preparation process and getting some better understanding of how taxes play a role in their finance. Because someone being a dependent or not a dependent on someone's tax return is more of a technical thing. This is what you should do to guide your kids. We know that we have a lack of education when it comes to finances in general in this country, and even a smaller amount of knowledge on how the tax system works and how to legally and ethically reduce the tax you pay in your lifetime. So I've been thinking about this for a while, and now my daughter received her first W-2. I'll just go like this. We don't want to put more of our information up there. And then my son was going to have a W-2. My daughter will actually have a couple W-2s. And the easy thing for me to do would be go take this as a CPA, put it in our tax software and spit out her tax return. But I also thought that, you know what? Let me do some tax planning for her. And also, let me start getting her involved in the process. Her other W-2 that she's going to receive will have tips on it as well. And then ironically, one of my best friends texted me like a day after my daughter got her W-2 and said, "Hey, my son just got his W-2. He's 17. Does he have to file?" So it's like, well, you don't have to file maybe, but we got to look at what state you live in, and should you file, and is it an educational opportunity, and is there tax planning opportunity, even if you don't know any tax?
And even when you say tax planning, right, like making it fun, and I say that loosely, right, because a lot of people are probably like, yeah, right, how could this at all be fun? Well, I think what you said and started to talk about there a little bit, involving them in that process when it's really like not stressful for that person to talk about it, right? Like if you're stressed about taxes in a whole, don't bring your child into it and stress them out before they even really get rolling, right? So just having them understanding it now versus when they're 35 and they're freaking out because they owe a massive amount or something, it's a lot easier now, right? So fun isn't necessarily like going out on the playground. Fun's just an understanding and involvement in it, right?
Absolutely. And like, for instance, we don't have a state income tax, so our filing threshold is pretty high. So my daughter doesn't technically have to file a tax return, even though she has 2 W-2s. Now, the question is did she have tax withholding on her W-2s that she could get back if she files? And then the other issue is there something we could do to help her in the future because she has earnings? And then should she file a tax return just to learn how that happens? Same with my son. My son, though, won't have tips involved in his W-2. I have not seen his W-2 yet, and we're going to look to see if he has withholding. So I think, let's talk about how, and just for context, my kids are 17 and 15 as we record this. So they're pretty young in this process.
They're growing up so fast.
They are. They're growing up fast, and in some ways not fast enough. But that's all right. That's another episode. So the first phase, we're going to call it the supported learning years phase. This is where we're kind of, in my opinion, we're kind of the Sherpa, right? We're doing a lot of the actual filing and looking at documents, but we're bringing them along. So if someone, financially in these years, usually the parents are funding almost all the children's expenses. If they've got a job, we're every parent's different, but for my wife and I, we're saying, look, we're not gonna, if you want to go out to the movies with your friends, you're gonna have to pay for that. Now if we go all as a family to the movies, I'm not making them pay for that, if that makes sense. So but focusing a little bit on budgeting and money basics. And quite frankly, for my oldest child, my son, it took him a year to save up to buy his first car. And we said, well, we'll match you, um, in buying this car. And then it's funny because he's like, well, I could lease a car because, I could afford that because of what I earn. And I said, yeah, but here's the thing. If you lease a car at a 16-year-old, 17-year-old kid, you know how much your insurance is going to be? Crazy amounts. So anyway, it worked out. He bought his first car. He got a really good deal on it. It's reliable. And we were able to match what he saved. And he learned so much and he takes a lot of care of it. So that's the supportive learning years. So if the child has a part-time job, they might need money for gas and fun, clothing, and knuckleheading around. And it's their first time that they could file a tax return. Now, even if they don't have to file a tax return, uh, I'm in a little different situation because I could prepare a tax return for them, and there's no cost to that. So I'm gonna do that for them, but I'm also gonna have them do it with me. And we're gonna do that together. And then my wife and I have decided to contribute to Roth IRAs on their behalf, for the money to grow tax free. And it's funny because my little 12-year-old, who doesn't have a job yet, at least formally, he's got his little dog walking gig around the neighborhood. But he's like, Dad, he came home from school a couple weeks ago. He's, Dad, I'm concerned about inflation. I'm like, interesting. So it's a great time to talk about the rule of 72. And we have a lot of content on that on our YouTube channel. But the point is with the Roth IRAs, and when I explain to the kids, like, hey, I'm going to put, let's say, $500 or $1,000 into your Roth IRA. Now, remember, with a Roth IRA contribution, you have to have earned income to make that contribution. So if you have a child that's earned $800 on a W-2, your maximum Roth contribution could be $800. But we know that money could really grow for them as into throughout their life. So we're going to match in a way the amount they earned to an extent through a Roth IRA contribution, and they're going to thank us later. So in those supported years, if they've got this part-time job, we'll want to file a return. Maybe they'll get a refund. Maybe we want to consider as parents putting money, or a guardian or grandparent putting money in a Roth IRA on their behalf. But we're really gonna lead the charge, right?
Mhm.
But we're gonna kind of take care of those things. But we want, in my opinion, it's best to have them aware of it.
And I love
And
that you've called it, the supported learning years, because I think now more than ever, right? It's even if, and I say a child, obviously I have a 5-year-old, so get a little bit more time there. But now you have kids that are, before they're even 10, they're seeing YouTubers, all this stuff making millions and millions of dollars. And it's widely known that they're making millions and millions of dollars. But to them, right, being so young and not understanding the system and everything, they probably think $1 million earned is $1 million kept, which is
right,
not the case, right? I mean, there's opportunities around everything, but even just them understanding a little bit, it's almost like in school, right? Where they try to find every single way when they're young to make it very applicable to their own lives. So they find it fun and all that. What you're saying is probably the best case scenario for them, right? Like they have somebody that could explain to them what's happening, but then also kind of walk through it with them. I mean, it could be the
right.
same thing if your dad's an auto mechanic, right? Like
Mhm.
taking the time, walking you through it. Of course, from that, you're going to have a better understanding, more respect for a vehicle, anything like that. So I think it's a great thing, man. Congrats there.
Absolutely. So the
Congrats, your
supported
old
learning
friend.
years are fun, and they're usually in high school. Maybe if a child does go to a trade school early in college, if they do go to college, that phase is important. Um, and the other thing, it's a fine line and for those of you that have teenagers, we want them to earn money. We want them to be responsible. But we also don't want them getting a B in a class that they should have gotten an A in because they stayed and worked extra hours and at a low paying job, if that makes sense. So there's that
Right.
fine line of balance, right? In making sure that they do get good grades, because in the long run, that's if they want to continue their education, that's really important. So, um, and same with sports and athletics. I mean, the vast majority of people, their athletic career is going to end in high school. So, I hate to say, "Oh, I'm gonna quit the tennis team so I could earn a couple more dollars." If you can, so you've got but that's a good learning lesson also for kids too. So yeah, those supportive learning years, there's a lot of lessons you could learn, not just about finance, but about life. Um, Typically once, if someone gets out of high school and starts, then there's the workforce. Now that could be right after high school. That could be after college graduation, up, kind of that 18, 19 to mid 20s. We call that, our shared responsibility years, right? It's kind of a 50-50 street here. We don't want the kids walking into those years from a tax perspective, having no clue of how the tax system work, has no clue about what forms to expect, how income is taxed. So we're sharing that responsibility with the kids. We're bringing them along, but think about this, John. I know your daughter's young. We're kind of putting those kids in the front seat now when we're driving, right? They're not in the back in a car seat. They're driving with us. At that point, kind of from a bigger picture, the child should start covering their living costs. The parents, we could help them and guide them into retirement savings and building an emergency fund. Maybe the child still lives under your roof, but hopefully they're productive, right? Maybe we can still cover their insurance. But at least we're sharing that financial responsibility with them and sharing that understanding of their tax situation. They may. I mean, a lot of these folks, these kids too, they might graduate from high school. Um, let's say they want to be a beautician, right? And they go to beauty school, and then next thing they know, they're 20 years old and they actually are independent contractors, and they're renting a booth and they're running their own business, and now they have to figure out estimated tax payments and all these things. So at that point, I think that those are the years where shared responsibility is important, and not just leaving them out to dry, right? But also making sure that they are pulling their weight from understanding their tax situation and financial situation.
Absolutely. Absolutely. So that gets us through the second one. So let me guess. 3 is the cord is cut. You're out into the world. Figure it out on your own. Maybe not that aggressive.
Absolutely.
They're
The
still welcome back for the
independent
holidays,
phase.
right?
Yep, they're the independent phase. So in the independent phase, the child is, they're paying all of their expenses. We are moving from being an advisor as parents or guardians or grandparents to advise. Rather, we're moving away from being providers to being advisors, right? We've lived a lot longer. We've probably made some mistakes, and the child is appreciating. Even in my phase of life where I could have a lot of adult conversations with my kids, maybe not super adult conversations, but like understanding how much things cost. So at that independence phase, the child is financially independent. We're hoping, right? Um, Now they might decide to get married, or you might decide to do a big family vacation where you understand that they might not have a ton of disposable income at that point, and you're, you know, as a you we still could contribute and help them out. I've seen many situations where where a child is renting a home, and they just can't, they can't purchase a home just yet. So the parent might loan them some money as a down payment. There's a lot of factors involved, but ultimately third phase, true independence, you're hoping your child can really handle their finances on their own. They understand because you have shared the responsibility and you have formed them. And I guess, like I said, the best way to describe this phase would be moving away from being a provider to an advisor. And also teaching them how to build their own personal board of directors is something that we talk about a lot. At this point, they probably are living independently. They're probably, and hopefully, thinking about retirement. We know how important that is early. They're probably carrying their own insurance. And they might start getting to that season of life where they have other people relying on them. And here's the tough part. And again, 25 years of experience, and I'm not here to judge. I don't believe that that's my role. However, I have many, many cases where I could tell you there are people that are in their 40s that their parents never took them into the shared responsibility years, and they never got truly independent. They never graduated, quote unquote, from those shared responsibility years. And now when they get to be older, they don't have the skills and knowledge to be independent. And that's tough, because that's tough on everybody. So yes.
This episode is sponsored by Wealth Builders Mortgage Group, powered by Movement Mortgage. one of the top mortgage teams in the nation, and a powerhouse in the real estate investing world. With over $1.1 billion in closed mortgage volume and more than 3,000 investor deals under their belt, they don't just talk the talk, they walk it. Their team specializes in helping short-term and long-term rental investors scale smart with customized lending strategies. They offer all STR loan products, including second home, investment, non-QM, bank statement, asset-based, and HELOCs. They also offer all primary home loan products too. Whether you're just starting out or expanding an existing portfolio, their unique Path of 10 strategy is designed to help you move from a 9-to-5 job to financial independence. If you're looking for a lending partner who truly understands the investor mindset, visit wealthbuildersmortgagegroup.com and start building your roadmap today.
So those are those three phases, right? We're going to start off with the the supported learning years, those shared responsibility years, and then, like you said, John, we're going to cut that cord, and we're hoping they're going to be independent. I mean, it's at least once a month, someone from our private CPA firm client comes to us with someone in their family having a financial need that they have a question about. So that just because someone's independent doesn't mean you can't help them or you can't, be there for them. It's just a matter of it's not your responsibility at that point. The child now is on their
The
own.
way that those 3 are broken down, I think is super important, right? Because it kind of alleviates a drastic kinda you're out into the cold all year round. Like, it basically sets the stage for it. It's almost like practice makes perfect, you have some time to do that, and obviously all 3 of those are not gonna happen in a 5-year window. So it's over time, things are built. So before we close out, the one question for you, this is kind of a personal opinion question and professional. Say somebody had a newborn, 5-year-old, 10-year-old, any of this thing. If they said, "You know what? I really haven't started anything with them. I really wanna show them how this works the best I can," them likely not being a tax pro. What would you recommend they do? Maybe one thing, and again, every situation is different. Would you say,
What age are we? Because a newborn versus a 5-year-old is a big difference, right?
let's say a 5-year-old, even like my kiddo. So we'll say a 5-year-old.
Sure.
Say, like,
At 5,
would you say the average person just throw a little bit and do a Roth or something so some money's in there when they have the discussion and the kid can understand it? Or, like, what
yeah,
would be
the
your
kid
opinion?
at 5 years old, you're not going to have a Roth IRA because you don't have any earned income, unless your
Right.
child is at 5 years old, and you have a business where they're getting paid on a W-2.
Which would be
So
a joke a long time ago, but nowadays, it's a whole different
it could
story.
happen. So at 5 years old, if you feel inclined to contribute to their education, I think having a 529 plan, and I think at that point, they that you can show them that you're contributing money to it every month, and maybe once every 3 months, you show them the statement of how much money is in that account for them. Now, if it were me, I would have you got to read the kiddo, right? I would talk to the child and say, look, this is a private financial situation. This isn't something you go to your kindergarten and start telling everyone that you have money in the 529 plan.
Right.
That's just, but what you want the child to understand at 5 years old is that mom and dad or grandma and grandpa or aunt and uncle care about them. They're, they want money to be there for them if they want to go to college or if they want to go to a trade school. And then as we walk into learning more about the Trump accounts, we're gonna have more content on that. That might be another vehicle for them. So I think them having the understanding at 5 that someone cares about them and they're putting money away for them is the most important thing. You might not want to even say any numbers. You might just say, "Oh, this is your statement. We're putting money into a college plan for you." You know, that's
That's
probably
perfect.
where I would leave it. Because again, if you show them that, it depends on how mature the child is. You don't want them going to their kindergarten or daycare. Oh, my mom and dad say, it could just come off the wrong way,
Right.
and that
And
sort of
also
stuff.
and yeah, I think too, thinking about my kid, right? Like, we've had actually plenty of talks with her, and I think the hardest thing to get through to her, and she's getting there a little bit, is that savings for something down the road is not next week when you wanna go to the toy store. It needs to stay in there to be valuable down the road. So, it's been a fun thing, but thank you for answering that. And I think that goes, across a number of ages too. Like you said, you gotta read the child. You gotta read the situation, read the relationship.
Yeah, I would say probably one of the best things my wife and I did from an early age is when we went on vacation, we gave them a budget, right? And no matter what it is. So that made them I can't tell you how much that makes them learn about stuff. Like, I'll give it like if we go play miniature golf as a family, I'm not dinging them out of their vacation money. But we go to the miniature golf course and the one child's like, well, I want to go ride the go-kart 10 times and we're all waiting for him. Okay, then you're going to pay for that out of your portion of. Now I got to think about that.
Yeah. That's a great way to do it
Yeah,
too.
so it's really interesting, and that teaches them quite a bit. So
Oh, it's a good example. That's a good example. And actually, that's probably a good place where we kind of close this out, right? So we've hit those 3 stages. Again, go back, anybody that's listening to this, if you kind of breeze through this, listen to it really quick, go back and listen to it one more time and maybe think about now from more an applicable approach, right? Like, how does that apply to you? Everyone, situations, families, all this stuff's so different. But I think those 3 phases will likely remain true
It
regardless, right?
right, and think about independence. It happens in stages. It's not by a certain date of birth. So even if you are, let's say you have a child that's in their early 20s and you really never talked to them about this stuff, it's okay to start now. And also, parents out there, I want your best tip. So I want you to go and put a tip that you've provided in the YouTube channel comments. All right. And we will share some of those in our private Facebook group called Defeating Taxes. I want to hear from you. I'll put mine in there about the budgeting and the Roth contributions also. But let's hear from you guys. Put it in the YouTube comments, and you never know. We might pick one, and we might send you a free gift or a free book.
Yeah.
Who knows?
Chris, I will match you on the challenge of posting things in there because I'm going to be on vacation out of state with my family, and I'm going to try that budget trick with my 5-year-old. We'll see how it goes. So I will report back to everybody actually in the comments on how that went, and wish me luck. So,
It'll go well.
it will. She's a smart kid, but awesome, everybody. Yep, as Chris mentioned there, you heard it straight from his mouth. Post that in the comments. They were super interested, what you guys have experienced with this. But then also, if you have any other questions around it too, drop them in there. I think if anything, everybody will probably learn from each other, right? Just the ideas of this, I think, are great. I mean, heck, we're introducing something as a whole through teaching tax flow, right? It's called tax planning. This is a component of it. I think it's just not for yourself, your situation now, or your situation in the future. It's your whole family, right? So this is very, very fitting to everything we're doing here. So defeatingtaxes.com, check it out. You'll see the invite to that group that Chris had mentioned, the private community, but then also just on teaching tax flow on YouTube. If you're not watching us, get on there, check it out. And as always, right? Great topics coming up here on the Teaching Tax Flow podcast. So we'll see you back here again next week. Different topic, same day of the week, a completely different date of the month. So have a great week, everybody. We'll see you back here very soon.
The information in this podcast is educational and general in nature. It reflects the opinions of Teaching Tax Flow and does not take into consideration the viewer's personal circumstances. It is not intended to be a substitute for individualized financial, legal, or tax advice. Consult the appropriate qualified professional prior to making any decisions. Securities are offered and supervised through Cabin Securities Inc. member, FINRA, SIPC. Investment advisory services are offered and supervised through Cabin Advisors LLC, an SEC registered investment advisor. Chris Picciuro is a registered representative of Cabin Securities and an investment advisor representative with Cabin Advisors LLC. Teaching Tax Flow is an independent entity and is not affiliated with Cabin Securities or Cabin Advisors.